Like a
Welcome. Wait, I didn't even. Do you want to do the second next episode?
okay, what is it?
This episode is on three different approaches to investing.
Sure.
It'll be a little bit lighter than the last one.
Yeah, let's try to
Okay,
keep
we'll
it
just talk a
quick.
little bit about alpha and beta, and
I know all about alpha. I am the alpha.
okay. Welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Tré Bynoe, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Aviso Wealth. Start with episodes 1 or 2 if you want to learn more about me. Okay, this episode is on investing. So, oftentimes I get a lot of people come to me or just in general conversation, where they don't understand. They think of it as my portfolio is going up, good. My portfolio is going down, bad.
Yeah, that makes total sense to me. Sorry, we're kind of in a goofy. Well, I'm in a goofy mood right now, obviously. So,
That's fair. That's fair. Okay, so benchmarking a portfolio is how we determine whether the strategy is working or not. Okay. Do you know what a
yeah,
benchmark is?
yeah. I don't know how
Tell
to.
me.
I thought I did. I'm also looking at your sweater that says bench right now. Oh
Yeah,
my gosh.
benchmark. See?
Yeah, I'm actually like losing my mind a little bit. I wanted to make a joke, but I couldn't. I wasn't fast.
Boy. Benchmark,
Anyways,
what is it?
a benchmark is
Think of your MS tests.
okay. Yeah, it's like the average, I guess. They're like, did you do better or worse than last time? Did you do better or worse than the last 18 times you've done these peg tests?
Exactly.
Right, with the peg.
Yeah.
It's fine motor skills. I don't have any, so
You
that's
just had
good.
motor skills. They renamed it just for you.
I call them gross motor skills when I'm like dropping stuff.
Okay,
Uh,
yes, that is a benchmark. It's what are you comparing it to?
yeah.
Okay, and that's a really, really important question when it comes to determining whether a portfolio has performed well or not, whether the manager has performed well or not. Okay,
Mhm.
so I'm gonna quickly go through three different investment strategies that people will use and the pros and the cons of them so that you can put them into categories better categories as an individual. Okay.
Okay.
So there's three types. There's indexing,
Mhm.
there's factor, and then there's alpha. Okay.
Mhm.
What do you think indexing is? Because you've heard me say that term
I
before.
know, and you know what? You have told me about indexing like so many times because I remember when I was a teller, I would get these little pop ups saying stuff about index funds. Do you
Oh,
remember
really?
that? No.
I don't remember you getting pop-ups about
It
it.
would be like not like not like a spam pop up or anything, but in I don't know if I'm allowed to say like the name of the whatever innovation. You sometimes a note would come up on people's accounts.
And it would say about index funds?
Yeah, it would be talking. I can't remember because it's been so
Oh,
long,
that's
but it was
interesting.
something
Okay.
about indexing, and I'm like, maybe I should not have admit to this. I'm like, what is this all about? Okay, close it. Anyways, what are you doing?
It's probably the index linked GACs that
Yes,
they do.
that's what it is.
Yeah.
Index linked. Okay, yes.
Yeah, I'm not talking about that.
Okay, well, I
If I
know.
if I was a bank, I would try to convince people that that was the best way to invest, so I could make a ton of money.
Oh,
And I'm pretty sure they're the most profitable product. We'll do it. You know what? I'm gonna add that to the list because I've had a few people now that come to me and they've asked me, "Hey, my person at RBC or my person at Scotia is telling me that this is a great thing to do. Is it?" And I'm gonna bring that up and
another
into the
one.
list.
Okay.
Anyway, indexing.
Okay, sorry, but anyway, that beside the point. I remember back then. I'm saying I just would exit the note, but I asked you specifically, what is the index linked note thing that I'm getting popped up? And you were like,
This
oh,
whole
it's
story about index notes, we're gonna go
yeah.
so off topic.
So anyway, back to the note.
Okay.
Back to my super
We're
interesting story.
gonna skip that story for now. We will come back to
Everyone's
that during
they're
the.
dying waiting
Well,
to
then
know
they
the
can wait
end.
for the index linked
I don't even know
episodes.
where the end is, so
I don't know either. Okay, an index fund is trying to track something, an index, something else that is tracking the overall market. Okay, so the S&P 500
Mhm.
is an index
Why?
because it's Standard and Poor's just said that this is like they make indexes. They make it's meant to be like an approximation of a group of a part of the market.
Okay, what? Sorry, define index again.
Okay, Google.
Google can't save you now. Just kidding. Yeah, I need to hear it in a sentence.
Okay,
Okay.
a market index is a curated portfolio of financial assets that represent a specific market segment, sector, or economy.
Is it
Does it help?
centered? First of all, I can't read from here, so I don't know what. I'm like, does that say potato?
What are you reading?
Oh, curated portfolio. I said centered potato. A curated portfolio of financial assets. Wow. That did not help. Oh, NASDAQ for tech. Duh. I'm joking. I have no idea. I don't know. That didn't help.
It's just a that didn't help.
No.
Well, we're screwed then.
I have no.
It's just a group of stocks
Okay. So
that.
somebody is like, hey, this
So there's
index
people that
is.
there's companies that make indexes. Okay.
So they're just picking a bunch of stocks and saying this index is the genre
Yeah.
is
Global. This genre is banking, global banking. This
okay.
genre is industrials, global industrials, or US industrials. This is Canada. This
Okay.
is, and there's certain, each index has different rules in order to be accepted as part of the index. So the biggest index on the planet by far is the S&P 500.
Yeah. Okay, that actually clarified it.
Okay.
Yeah.
So a lot of people will think, for instance, that the S&P 500 is the biggest 500 companies in the US. It is not.
Mhm.
It is the biggest 500 companies that meet the requirements of being in the S&P 500.
Mm.
And this was a big deal for Tesla, for instance. Like Tesla for a long time they were big enough to be part of the S&P 500, but they didn't meet the other requirements, so they were left out of the S&P 500. And as you can imagine, Elon Musk had very choice words to say about it
Yeah.
for a very long time. But finally, they were added. The whole big thing. So the index is just this measurement.
Okay.
Okay.
Yep.
An
Yep.
index fund is trying to match that measurement.
Oh, sorry, you had me and then you've lost me again.
So, for instance, you cannot invest in an index. I cannot say, okay, I want to put my money directly into the S&P 500 because it's not a product. It's just a list of names. I could go buy the names on the list, but I can't directly invest in the index. I
So
would
is
use
the
an index fund.
the like requirements, like a piece of paper that says here's the requirements and these companies fit these requirements and you're like, okay, cool, that's the index. Now I want to purchase it, so I have to either buy every single one of those companies or they've set something up where it's
Yeah,
a
lots of
fund.
different companies. Yeah. Well, then, so for example, Vanguard, which is a fund company, or iShares, or BlackRock is a fund company.
Yeah.
They will go and make a ETF or a mutual fund or something that imitates the index
Okay.
that they're trying to copy.
So they're like, we went and bought all of these.
These 500, if it's S&P 500, these 500 names.
Yeah, and you can
Now give us your money and it will go into this ETF or whatever that is trying to mimic this index.
Okay.
Okay, so the way that you would determine the performance of that index fund is by comparing it to what?
The index.
Correct.
Okay, I thought
It's
it
not a
might
trick
be.
question.
Yeah, I was like,
No. So that's how you would determine whether that index fund is doing well or not. It's comparing it to the index. If the index is down 50% and the fund is down 48%, the index fund failed.
okay,
Okay?
okay,
They are very clear. An index fund's job is not to make money. An index fund's job is to follow the index as closely as possible.
okay.
Does that make sense?
I think so. I just feel like my mind is kind of giving me some questions, and I'm not sure if I.
Hit me.
So,
Just out of curiosity, like apart from your mind giving you questions, who else would be?
the other voices.
Okay.
Shh, private. Just um, I sorry, I gotta go back to that. Okay, so there's multiple companies that are trying to follow the index. How is that a hard task, I guess?
It's not. That's why they charge very low cost for it.
Because it's like, oh, you didn't follow the index. It's like you just have to buy these companies.
It depends. S&P 500 is a bad example of a type of index that people would struggle to follow because it consists of very large companies. But think of if it's a all world index, or some companies are so small that it's difficult to buy a meaningful share of the company, or there could be restrictions, or there's a whole host of reasons that could cause it to not keep up with the index. Okay.
Okay, yeah.
And I'm going to throw in a side note here. Side note alert, I guess. I'm going to use the cog analogy again.
I thought you were gonna say I'm gonna use that from now. Like side note alert. I was like,
There should be.
okay.
There should be. If it links to a different topic, I'm going to use it really quickly.
The cog.
The cog analogy. The fact that an index fund is forced to rebalance during certain periods of time if the index changes is a problem. Okay? If a company is removed from the index, that means that index fund has to sell that company.
Yeah.
Okay?
Yeah.
That creates a problem when it comes to investing as tax efficiently as possible.
Wouldn't it also change like the distribution? Because okay, remember a long time ago we were looking at fund facts?
Fun facts.
Fun facts. Anyway. And there were percentages of
Yeah.
the companies. So if you took one out, wouldn't that change everything as well?
Yep. And then
Okay.
that means that they would then have to, and that is another reason why you might have differences in like where the index fund isn't quite the same as the index that it's trying to track, right? Flows in and out of the fund, if they have to sell because they don't have enough cash and there's a big withdrawal for some reason, might impact these types of things. Okay.
Okay.
So that's just something to keep in mind when it comes to investing. I wouldn't even say to keep it in mind. It's a side note that is a cog that will impact other decisions that you would make. Okay. But that's an index fund.
Okay.
The like index strategy, I guess. Then there is factor strategies. So a factor is a characteristic of a company that historically has performed in a certain way that means that they can group them. So for example, value. Okay, value company often means that it's a stable company, typically lower valuations on like multiples of their earnings. Think of a company like value company that you would know. Suncor. No. CN Rail.
Okay. Yeah.
I wouldn't quite classify them truly as fully value, but that's definitely think of that type of company versus Nvidia versus Google.
But I just don't understand why. So the value.
So one of the companies is growing very aggressively, like they spend a lot to grow. And the other type of company tends to be more stable, limited growth opportunities,
Okay.
more established type companies.
Yeah.
Okay.
Yep. This is again, my mind is going to marketing because there's 4 different quadrants. I can't remember them off the top of my head, but one type is a cash cow and one type is this. So you're either like in the stable or you're growing really
Hmm.
fast or you're like going down or you're staying. Yeah.
Yeah.
Very
So
similar.
but basically there's different factors that historically have been a persistent source of excess return
Hmm.
over indexes typically.
Okay.
Because if it hasn't outperformed indexes, why wouldn't you just hold the index?
Yeah.
Okay,
Yeah.
obviously.
Yeah.
A combination of these two is how I invest, in fact,
I knew it. I was gonna say I bet.
for the majority. Okay.
Yeah.
Alpha seeking strategies. This means alpha is returns in excess of the index. So if the index, remember I said you have to, in order to evaluate how well an investment is doing, you have to compare it apples to apples. You can't be comparing two completely different mandates, right? So if I have a US equity strategy, then I should be comparing my active manager, the person that I'm picking to try to beat the market,
Hmm.
to the market that he's trying to beat.
Right.
Okay.
Yeah.
Alpha strategies, alpha seeking strategies, vast majority of them underperform.
I knew. I was again. I was like, I feel like you don't like alpha.
There are some things that they have done much better than others. So something that we have seen them persistently do is help on the downside. So when you look at companies, and that's really where you're gonna get and hope to get the biggest benefit is them protecting on the downside, because we have seen time and time and time and time and time again that to pick a stock or to pick a handful of stocks that outperforms the overall market is very difficult to do and very difficult to stick with for two major reasons. First off, you have to be willing to stick to that strategy, stick to that thesis while you're drastically underperforming everybody else.
Yeah.
Okay. So a lot of people still think of investing as like a January to December 31st type of thing,
Yeah.
because that's just the days on the calendar versus a much longer time frame. So to stick to an underperforming, something that is not even underperforming, they could be performing 5% a year, which isn't bad, but then you compare it to the index, which is up 20%, then suddenly you might
It's
want to
looking pretty
be
bad.
looking pretty bad, right? So oftentimes we don't have the ability to stay in the game for that length of time to really get the benefits of it. And
Hmm.
then the other thing is cost. Just the nature of active management means that there comes a higher cost with it, which
Hmm.
means that in order to generate a return in excess of what you would have gotten if you had just bought index funds, you have to not only beat the market, you have to beat the market by
Plus.
exponentially more than what you would otherwise had to do.
Hmm.
So even when it does come down to, oh, the manager is skilled,
If they're
fees
skilled,
often
they're gonna
eat
want to
up,
charge more even.
right? And that's where you get, there's plenty of like hedge funds and things like that charge the famous 2 and 20s. They charge 2% and then 20% of the growth. And it's like, even if they could, guess who's making all the money? They are, because like they're the ones that, in order to pay for that skill and all these analysts and all this stuff, you need to pay them, right? And they don't get, they're not the, they don't operate on a barista salary, that's for sure.
Yeah.
So some of the brightest minds in the world go into that section trying to beat the market in certain areas, and again,
Still.
very few have ever been able to do that consistently over a full
Hmm.
market cycle. And you do get the outliers. Warren Buffett is a prime example of that. Warren Buffett has also had significant periods of time where he has underperformed the market.
Yeah.
So it's, again, it's one of those things that it can be done. Is it worth the risk of underperforming, which is the most likely outcome?
And the time
I don't
again.
believe so.
If you're underperforming, you're missing out on time as well because of compounding.
Absolutely. And I always say my goal is not to get the best possible return because I don't know exactly what's going to get the best possible return. My goal is to minimize the risk of a bad outcome.
Yeah.
And it's like when it comes to certain types of risk, I just think the risk of a bad outcome is too high in order for it to be worth the risk when we can just take a much lower risk of bad outcome route and almost as close to guarantee we get to the end result as possible, right? I sleep. And that's why I say like I can invest 100% equity and have an iron stomach is not because I'm superhuman. It's just because the way I invest is very different than what would give me
Yeah.
the scariness of,
The
you know,
scariness.
if I'm investing in a company and I have $1 million in a company and the company drops 50%, I am scared. I am terrified. If I'm investing in every company in the world and the markets drop 50%, I don't care. Like something's clearly happening. If that, whatever that is happening, destroys the entire global economy, having my money in cash ain't gonna help me either.
Yeah.
So
We've got bigger
we've got bigger
problems.
problems.
Yeah.
So it's not as I don't care as much. But if it was a handful of companies, yeah, I'm worried.
Yeah.
So just the way of investing is important here. So
Yeah.
those are the three main types of investing.
Mm-hmm.
Again, as I've said, I fit more into for a lot of things, but I do use active strategies sometimes, and it oftentimes it's there to reduce the ups and downs of the portfolio and to allow people to stay invested through the ups and the downs, the good and the bad times.
Mm-hmm.
Is mainly that's the only reason I would do it. It is not optimal. I do not use it thinking that it is going to outperform or anything like that.
Yeah.
It's purely I need to make sure that if we are going to be investing this way, that you can handle the ups and the downs. And I'll tell him that it is suboptimal. It's likely not going to work out. But again, if I am going to use it, then I'm looking to minimize fees as much as possible, right?
Mm-hmm.
Like some of my strategies they cost 50% less or more than the average what you would get from other places, right? So it's like cost is such a huge factor when it comes to investing.
Mm-hmm.
But yeah, they're the three different types that you
So
can
would
use.
you say generally your strategy is factor index like a combo and index factor alpha if necessary, like adding the alpha in?
Yes, basically.
Okay.
Yeah. It's not a case like it's not a case of like the factors are real. It's a case of whether the company can target them appropriately for a low enough cost for it to be able to outperform. Like there's enough data. We have the data. We know, for example, that small companies outperform
We've talked about
bigger
that.
companies.
Yeah.
And that's just if you think about it, you know it's true.
Yeah,
Right? It's
it
like
makes sense when you
it makes total
actually think
sense. Yeah.
about it.
It's like, okay, yeah, well, doubling Nvidia is a lot harder from a 5 trillion, sorry, billion, small numbers, $5 trillion valuation is much harder than doubling a company from $1 million to $2 million,
Yeah.
right? Like, I get what you say. It is always going to be easier to do that than the other way.
Yeah.
It's just a case of if the company can effectively access those factors, those sources of extra return.
Mm-hmm.
So yeah, and again, alpha. When you look at the numbers are there. We have them. I think it was like 98% or something crazy high of active mutual funds didn't meet their benchmark, underperformed what their index would have been if they just bought the index. That is a losing battle to say the least.
Yeah.
And then when you look at, again, there's a big study. You might even do a whole episode on that. But even when you look at ones that do outperform, you have to think to yourself, okay, now I need to determine how to find these managers ahead of time, which again, when you look into it, there is no consistent way to do that.
Yeah.
So it comes back to the case of, okay, what is going to be the least risk of a bad outcome? And that's really how I make decisions is a case of when you look at it, it's like, okay, what's the cost of me being wrong? Okay, is it really worth it to take that risk?
It almost feels like the alpha one is a little bit of a gamble.
It's a gamble that you expect to lose,
Yikes.
right? Like, I'm going to look into this. I think you might have better odds in Vegas. Like, literally a roulette table would have better odds than you beating the index. Obviously, there's different type of risk. You don't lose your money if you don't beat the index.
Yeah.
Different type of risk.
You're
But
not saying
but when you're looking
gamble.
at, like, if you're looking at, I think what's a 48% chance at red or 48% chance at black, that's a better odds than beating the market.
Look it up.
I have to look it up.
Yeah.
But yeah. Anyway,
Okay.
those are the three types. So when you're comparing yourself even to a friend or whatever you're doing, just keep in mind that you should be comparing apples to apples. If they have 100% Canadian portfolio over the last year and you have a 100% US portfolio over the last year, odds are the Canadian portfolio outperformed, right? You can't compare a 100% Canadian portfolio to a 100% US portfolio and have a realistic conversation about comparing the two, because they're completely different portfolios.
That makes sense.
Right? But if one of you has a Canadian active manager and 100% Canadian portfolio and the other person is sitting on a 100% Canadian index fund, now you can have a conversation about outperformance or underperformance, right?
Yeah.
So just when you're comparing it, compare apples to apples.
Yeah.
Okay. That's everything from that episode. Did you have any final questions or anything?
No, that one was quick and easy.
Nice. I'm glad you loved that one.
I felt like the beginning, I was like, really, I felt like I was going to have a fit of laughter. Like, I was a little worried. I was like, pull it together. Now
You
I'm
just find
tired.
it so enjoyable.
Yeah, I do.
Okay.
I like the podcast.
All right, perfect. The next one, actually, I'm not. Okay, I'm gonna stop saying what the next one is, and we can just,
Because then we can pick what
because I have
we
a
want.
giant list, and I feel like depending on how you feel, it's kind of like how we should vibe it up.
Vibe it up.
Vibe it up. Okay. Anyway, we'll see you guys in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bynoe, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.